You just send this to the team, by the way. The new link.
YouTube link, send it.
Hey guys, for anyone that's listening in on YouTube, do you mind just saying hi on the chat window if you guys can hear us? All right, perfect. So we're going to start this lesson in a bit, in about like 3 minutes now. Aaron's going to be presenting this lesson for you guys. Please keep your questions till the end. We'll have a Q&A session at the end, so you guys can ask away. If you do have any questions, just what I like to do is I just write it down on my sticky note so that I don't forget to ask that question later. All right, that being said, I'll let Aaron take over.
Hey guys, my name's Aaron. I'm a OrderFlow trader in United Traders. We're gonna give maybe like 3 or 4 minutes to let some more people join in since we create a new link for this. So we'll be quiet for a little bit and let everybody join in, and we'll get started about 3 minutes. All right, guys, can everybody hear me? We're about to get started. Looks like a good amount of people have joined in now, so we'll get things going. This will be a presentation on Bookmap. It's an order flow software. It recently got integrated into Thinkorswim platform, which is what a large majority of retail traders use. So we're going to go over the basics of how to get this added to your Thinkorswim software. And then we'll give an explanation of what you're looking at when you open up the software, as well as different uses and ways it can help your trading. If there's any questions, like TJ said, if you can hold them off until the end, and we'll go through everything all at once. Okay, let's get going. So a little bit about me. Looking up on the screen, you'll see my Discord, as well as a few different ways in which I trade and tools in which I use when I'm trading. The depth of market is my main trading tool. It's otherwise referred to as the DOM or the price ladder or active trader on Thinkorswim. Every platform has their own name for the depth of market. And it's pretty much your auction market that shows you your order book and the price and different market orders hitting the order book. After that, I use the time and sales windows, which is the tape. I use that to look at executed orders to tell me the intent of the traders currently trading at these price levels. Footprint chart is another decryption of the tape. It plots out market orders on candlestick charts or on a chart basis. Volume profile is something a lot of us use. You can use it on TradingView. It shows you levels at which price was traded at. Heat map is what we're going to be looking at right now. It's what Bookmap specializes in. It's the historical order book, pretty much. It shows you where limit orders were on the book at different time periods. Options flow structure. It's no secret. A lot of people are catching on now that the options chains have a large impact on the price of equities. So a lot of the things you see on options chains can impact the price levels. Macro factors is something I use as well. Understanding different macro news and earnings and different events is something that I like to use when looking at my price levels and entering trades in and out every day. A quick disclaimer, guys. Statements by United Traders or its members are opinions and not investment advice. UT is not responsible for any investment decisions made using the information provided. Improvements are not guaranteed. This material does not take into account your particular investment objectives, financial situations, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on UT. As I like to say, past performance is not indicative of future results, guys. So please protect yourself, protect your accounts, and do your own research. So getting started, when you go to Thinkorswim, on your top right corner, you'll see a support button. I have it outlined in red here. You want to click on that support button, and it'll bring up a chat window with customer service for Thinkorswim. They have an excellent customer service. They answer any question you ever have. And I always recommend anybody who's asking me questions about their specific software to get in touch with their customer service reps for their specific software. Here I wrote down, it's very simple. Can I have access to Bookmap? You hit that send, and within like an hour or two, their customer service works during regular trading hours. They'll get back to you and they'll ask you if you want the free version or the paid version. I believe the paid version is $40 a month, and it gives you access to all the equities as well. Whereas the free version gives you access to 3 sample tickers. One is the ES contract, which is the futures contract for the S&P 500. I believe the other 2 are Apple and Microsoft tickers. So it's very useful. If you don't want to pay to get full access, you can use that just to see the S&P 500, which is a good gauge of the price of your entire equities market. So now that we have that, once customer service replies to you and they install it on your Thinkorswim, you just get out, re-log back in, and you'll have this Bookmap tab on your top left corner. I have it outlined here in red. And once you click onto it, that's what starts your Bookmap for you in Thinkorswim. If you have the free version, it'll go to this page right here, and it'll let you click on one of these three to load it up on your chart for free. If you have the paid version, you just go in similar to the regular chart and you type in your ticker symbol and it'll upload that into the chart. Once you click on your symbol, it'll take you to this page. You'll notice it's in the Thinkorswim platform, and everything else down here that's shown is directly crossover from the Bookmap software, which they have as a standalone. On your right-hand side, where it says Bookmap, below that, you'll see the price levels. This is your y-axis, and this is the price of your tickers. Now, to the right of that, you see what's a column labeled COB. That is the current order book. So the price is currently at $4,113.75. Above that, you have limit orders on the ask or the offer. And this is the quantity of limit orders at those price levels. And you'll see it has a histogram here. The more orders at that price level, the larger the histogram. So it's trying to show you which levels have larger liquidity. Same here, if we go to the bottom in green, those are your limit orders on the bid. And these are resting limit orders at each price level. The histogram shows you more or less which ones are larger than the others, relative to what you're looking at the screen right now. Now, if we look, let's ignore this last one right here because this is aggregate. It's not really necessary right now. Now let's look at the left of the price axis. You have a bunch of different colors, and you have a green dotted line and a red dotted line. The green is your best bid. So we can see right here, the best bid is currently at $4,113.50, and that is where your best bid is, this green dashed line. Your red dashed line is your best offer, and it's gonna these lines are gonna move along with where price is changing, price is currently trading at. When all four of these contracts are executed and no one else puts limit orders here at 14, the best offer will move, and so will this red line. On top of that, you see these blue and different color horizontal rectangles here. This is the top of the book. So at this current moment in time, this little blue vertical line on the right of this is what the book is currently showing. And what it does is it mutates these numbers into colors. So if we look over here at the top middle of your screen, there's a little bar and you can change your color format. But here what it's showing you is the lower amount of limit orders, the darker the color is right here, black, blue, white, yellow, orange, red. So red is going to be your largest limit orders or your highest liquidity pool. Right here, orange is your largest one. So this 9, it turns this price level orange because this is currently the highest amount of orders at that price. Sorry. So that's what it's doing. When you're looking at it, we'll populate this next, and I don't want you guys to get too overwhelmed, but essentially what it is that it's putting these limit orders that are in quantities of numbers of contracts, and it's changing them into colors so you can see them in a color-coded format without having to look at the numbers of each of one of them, because what you want to see is relative size. Okay. So let's go into some quick terms. These are ones I'll use fairly often. You don't need to memorize all these. We might go into a deeper dive of what some of these mean in future lessons when we talk more about auction market theory. Liquidity is the first one. Liquidity is limit orders or depth of market where traders are bidding and offering to be buyers or sellers. So that's a limit order is what I refer to as a passive order. That means if an iPhone is selling for $300, you're like, I don't want to buy it for $300. I'll put a bid to buy an iPhone on eBay for $295. And when it gets to that point, they'll fill me on that order and I'll be able to buy it for $295 because I don't think it's worth $300 yet. And that's why we say it's passive, because you're waiting for price to get to where you want it to be. BBO is the best bid or offer. It's level 1, top of the order book, inside market. Those are different terms that all mean the same thing. Pretty much it's your best bid and offer at the current time is your BBO or your top of book or your level 1 data. Hitting the bid. Hitting the bid is bearish. Hitting the bid is when a market order executes on the best bid. It's an aggressive market sell order. Lifting the offer or slapping the ask or lifting the ask. All these different phrases mean the same thing. They're all bullish. And what they mean is there's aggressive market buy orders being executed. LOB is the limit order book. That is what we showed on the DOM in the previous slide. CLOB is your centralized limit order book. This is something like for futures. I'll just do a quick explanation of this. Futures trade on one exchange. It's the CME exchange. When we're referring to ES, there's the CBOT, there's the New York Mercantile Exchange. There's all a centralized limit order book because they all get routed to the same exchange. When you're trading equities, you'll notice on level 2, there's ARCA, Edge, NASDAQ. There's different exchanges that they're getting routed to. Whereas on futures, if you're trading ES, it's going through CME only. If you're trading gold, it's going through COMEX or something like that. So that's the reason why that terminology is there. And once again, DOM is the depth of market. That's your limit order book. Aggressive volume is classified as market buy and sell orders. When you use a market order, you're aggressive because you're taking whatever price is available. Intent of trade. We use this a lot because we want to know the intent of traders when we're looking at these price levels and limit order books. And that's where traders are lined up to trade at. Delta is net market orders. This is used a lot. There's a lot of indicators called cumulative delta across different softwares. That's your net market orders. So that's buy market orders minus sell market orders, and that gives you your cumulative delta. And then you can have your session cumulative delta, which is from the time the regular market trading hours start to the time they end is your session. Liquidity pools, they're small sections where a cluster of orders are placed, and these are areas of interest. So when you see a price level high up on the ES where there's a lot of large limit orders just stacked back to back to back at different prices, that's an area of interest. And when price gets to that level, we want to see how market orders interact with it. Liquidity vacuums, I'll go more into this later on because there's a couple different interpretations of this. Essentially, it's when price, say a large market order gets executed at the current bid, somebody puts a large market buy order and it takes out multiple price levels. So what that does is it creates a liquidity vacuum underneath it because nobody's putting these limit buy orders in fast enough to fill in. So price can quickly retrace in those instances. Heat map is your historical limit order book. The current order book is the current state of the limit order book. That's what's going on right now at this specific point in time. And that's like on the Bookmap page I showed you previously, it's on the right side of that vertical blue line. So that's the current order book. And the historical order book is what they show on the heat map to the left of that vertical line. How the Bookmap can help you as a trader. Heat maps show you the historical current state of the order book. So what that does is it tells you how these larger players that have these large limit orders, how they move their limit orders around. So at one point in time when price was trading at say $3,000, if they had a large amount of limit orders at $3,100, and then when price got closer to them, if they started moving the limit orders around, that's what it's showing you. So you start to do this art form of trying to figure out what their intent is. And that's how it can help. So it's showing you the liquidity at each price level. It's showing you the best bid and offer, what the spread is. It's showing you the current price and the last traded volume. Now here we get into what Bookmap looks like on a regular trading day. Here we have a screenshot of the ES contract, the current month. On the top, you'll see the ticker. They're derived .cme for the exchange, and at Rhythmic is the Rhythmic data feed. If you're trading this on Thinkorswim, you don't have to worry because you're not paying for a data feed. Thinkorswim pays for it for you when you have a live account. So right here, you can see that it's showing you the heat map on the left side. It's on a time axis. Your x-axis is time. And you can see that each vertical white dotted line is 30 minutes. So in 30 minutes, that's the price range that price went through. It's also showing you the current order book on the right of this white horizontal vertical line where you see your dashed lines. And it's showing you the depth of market, which is that current order book vertical column. Let's talk a quick bit about order flow data. Current data equals the real-time depth of market. It's fleeting and it only displays for a current moment. So when you see price ladder traders, a lot of prop firms, they have their guys trading on price ladders instead of charts. That's kind of what it's talking about. The reason why Bookmap started is because on a price ladder, these numbers are constantly changing. So if you're not always watching and you don't have a good, you're not comfortable with trading on price ladders and that market you're trading at, you'll forget where these large liquidity pools are and how price is moving. You're just looking at what's currently going on. Since these price numbers are not recorded, it just shows you what is currently going on right now. So that's what heat maps and Bookmap does. They record that and they show it to you on your screen to the left. It makes it easier to see the data and how it unfolds over time, and it provides you a lot more context. Whereas a price ladder trader, you have to be very comfortable with your market. You have to know like the ins and outs of it, so you only care about what's going on at the time. For some of us who trade multiple markets, this heat map is very useful because we just go to that ticker and it shows us how these the order books moved over time and where market orders have been placed. Why does price move? I've heard this a lot. A lot of guys will say, oh, look at this volume bar on their trading view chart, and they'll say, wow, there's so many buyers. They just overwhelmed the sellers. Any volume bar is a executed contract or an executed share. There has to be a buyer and a seller to produce one unit on that volume bar. So there's never going to be actually more buyers or sellers on any one end when you're looking at a volume bar. What changes is if there's more aggressors or who's more aggressive, which side is more aggressive. If buyers are more aggressive or sellers more aggressive. When there's a lot of aggressive buyers, they're going to hit more market orders, and that's what changes price there. Because buyers are more aggressive, they're eating up all the liquidity, and that's what's changing price because they're eating the liquidity at this price level, they're eating the liquidity at the next price level, and they're just being so aggressive that the sellers cannot replace those price levels in time, and price is now moving. The intent of trade is what moves the price. Limit orders, as we talked about, are passive orders. They provide liquidity. Market orders are aggressive orders. They cross your spread and they consume liquidity. So they're liquidity eating orders. A transaction is always when price trades where the aggressors match with the best bidder offer. So if the spread on ES is one tick, that means that if it's currently trading at 4,000, if the last trade is 4,000, your best offer may be at 4,025, and your best bid may be at 4,000. If I hit a market order to buy, it's going to cross the spread and execute on the best offer, which is 4,025 cents. And that's where your transaction takes place. Once again, why does price move? It moves because there's an imbalance in the intent of trade. A large imbalance in the order book skews the auction. Size of limit orders affect the best bid and offer. And market sale orders hit the bid or the ask. Transactions occur at a new price level, and that's where your new last traded price updates on your brokerage platform. Let's take a look to like a simple understanding of what Bookmap is showing you. This is order book imbalance explained. On your x-axis, you have time. On your y-axis, you have price, similar to most charts. And let's take a look at these contracts to your right as what's at the current limit order book. So on the best offer, there's 12 limit orders to sell. Right above it at the next price, there's 120 limit orders to sell. And at the next price above, there's 85 and so on to 72. On the buy side, we have 15 limit orders to buy on the bid, and that's where our current price is. Below that, we have 18, 22, and 34 contracts at the very next price levels. Those are limit buy orders. So we see here somebody sold a market order quantity of 1 contract. So that market sell order hit the bid and it executed at the bid, and that is your last traded price, because the last trade was a sell market order that hit the bid. That's now your last traded price. Okay. Supply imbalance. So when the auction is skewed, it seeks balance through price revaluation. Liquidity is pooled, spread widen as the best bid drops 2 ticks in this example right here. So the same setup we had on our previous slide. Now there's a sell market order and it took out these last 2 limit order prices on the bid. So now the next market order to sell would hit the next best bid, which is 2 prices down at 22 contracts. So whenever a sell market order is now placed, your next last traded price that shows up will be the best bid price. Now, when price moves and they transact on the best bid, now that price has moved to that best bid at the lower 2 levels down. Somebody hits a sell market order, it hits that contract amount, it drops that 22 contracts to 21 contracts, and that's now your last traded or your current price. Your spread widens because these limit sell orders, nobody changed. They're still sticking to their initial price. Now your spread's wider because there's no sellers coming down and placing limit orders at these lower levels, right? Moving on, depth and balance. This is kind of more of an advanced concept. You can use it for momentum strategies. There's some different phenomenon that cause this. Spoofing is something people have heard a lot. It's when people place large limit orders to make people think something is going on, and they pull them with no intent to execute. They'll layer them together. So that's how we talked about where there's a level where there's just a large amount of limit orders back to back to back at different price levels. That's important. Iceberg orders. Iceberg orders I placed a lot of weight on because nowadays some larger traders will tell you like they hide their orders. They don't show them on the order book. You can see that as icebergs because when say you only have 21 contracts on your best bid, there's 20 contracts executed, sell market orders executed at that bid, but somehow it's still staying intact. What's happening is there's these hidden orders or icebergs that are reloading here. So they're at that price and they keep reloading as needed whenever market sell orders come in. So that limit order might change on the best bid, but it might not get wiped out because there's an iceberg just reloading limit orders there. Okay. When we see large limit orders above that are not at current traded price, we want to wonder if there's potential spoofs, what their intent is essentially. We don't want to completely discredit them. Like a lot of people talk about, oh, they're just spoofs. Well, spoofs are always there for a reason. Regardless of, people needed margin to place these limit orders. So that is why they're important to us. They have some type of intent when they put them there. It might not be to get executed, but that's what you're trying to figure out. Because they didn't put them there just for no reason. They had to take margin out of their account to place those limit orders on the book. Even if they don't mean to execute them, they're still consuming margin on their account that they could have used for other trades. So it's significant to some sense. Okay. Now, when all liquidity is taken, in this example, there's a market sell order of 15 lots traded. So a 50 lot order now turns into 35 lots. An aggressive sell order hits the bid again at the next price level, and it widens the spread by 1 tick. So we still have our best offer with 12 contracts waiting to get executed with 12 limit order contracts. Now somebody hit a market sell order for 15 contracts and they executed on the best bid. So now that liquidity area was taken, it was completely consumed, and price now moves down to the rest of the market orders now move down to the next best bid. So those 35 lot orders, now the rest of them, whatever wasn't left there, they now get executed at the next best bid. And that's when you see your spread widen, or you'll see this a lot of times where price moves quickly through levels because there's a large amount of market buy orders and there just wasn't enough liquidity that they have to keep moving price down to execute all those market buy orders. Because as you guys have seen, when you hit market buy or market sell, it has to execute. So it just finds wherever that next liquidity is to be executed, no matter how far up or down it is, and that's where you get slippage. Okay, now that we have a little bit of understanding of what you're looking at when you're looking at Bookmap, let me show you another reason why it's pretty useful. If we look at this chart, we put regular candles on this chart. Now, if you look at the x-axis at the bottom, each of these white vertical dashed lines are 2 seconds in between. So in those 2 seconds, it shows you how far up and down price moved. And that's what I consider microstructure, because it's showing you a lot more detail than you would normally get on a candlestick chart. These dots right here, they're called volume dots, and they're just executed market orders. So if somebody executed buy market orders, they could be green dots. If they executed sell market orders, they could be red dots. So you can see here what's going on. Whereas on a regular chart, you'll just get one candle. With Bookmap, it shows you microstructure detail. So you can see a lot more context into what happened in that one candle. So with these candles are actually like 5-second candles. So even though they're 5-second candles, which people would consider crazy, there's a lot of context that can go on. And this can be useful for a scalper, depending on what your time frame is. If you're a swing trader or something like that, this might be too much detail. It might, and similar to the way I approach most things is, if I don't use it in my trading, the only thing I want to understand is the theory, so I understand how things work. I don't necessarily need to implement all these items into my trading directly, but knowing how they work helps me understand how different price action things, why they happened in the market. All right, now we'll go through some examples of some different setups you'll see on Bookmap. I won't give too much explanation because we don't want to go too far into detail here, but we just want to show you some ideas of what you can see on Bookmap. Here is ignition liquidity. Here you see at your far left yellow oval, somebody placed limit orders on the order book for a very small amount of time. And as price went down, they moved their limit orders on the offer down with price. And when price came back up, they didn't pull them. They got executed to some extent here. So because it's dark white, that means that there was a lot of limit orders relative to the rest of the order book, and they allowed market buy orders to get executed, so they absorbed those. So when I start seeing that, I'm trying to figure out, what is this person's intent? Why did they start high and they moved down with price? And when price came back up into them, they didn't pull, they got executed. So now I want to watch to see if there's any more large orders as time goes by. As time goes by, you see some more large limit orders right here on the second yellow oval. They get executed. Price kind of stays in balance for a few seconds. And they place another liquidity pool of limit sell orders down here that they're getting executed on. Now, once again, price drops down. And as soon as price drops down, you see them start a limit order again. As price comes up, they drop their limit order price down some more and they get absorbed. So they're executing these contracts. So now I know at this point in time that this person is either trying to get out of a position and he's being aggressive with his passive orders, and letting them get executed, or he's building a short position, one of the two. So now I have those options in mind, and I can start to create some trade biases based on different things I know about the current trading day. Now, if we move on, you can see once again, he even gets more aggressive. He puts a large limit order much lower than he initially did. It's a full handle down. And once again, price goes up into it and he doesn't pull, he gets executed on some. Price retraces back. And now we see one final time on this right yellow oval, price starts to drop. He puts in his limit orders with it. As price drops, he's coming down, coming down, coming down. And price just gets completely pulled all the way down. Some of these larger limit orders on the bottom, they pull, they don't get executed on. So with that liquidity being removed, price now seeks the next liquidity level. it gets executed on down here at around 57.61.25. Completely overwhelms them, keeps going down to the next liquidity pool, and it just keeps going on until it gets exhausted. So this guy, now that that happened, we can speculate that he was building a short at these levels and then just rolled price all the way down. Okay, so that's one way to use the heat map to see historical limit orders, how they're getting executed on, what's going on when price trades around them, and speculate on what's going to happen with price based on these participants that are using a large amount of limit orders to build positions or exit positions. Moving on, here once again, we have the ES contract. And that you right here in the middle, you have your yellow oval. What you see here is the best offer has a large amount of limit order contracts. We have 1,137 limit orders at the ask right here, and they're getting executed on because they're right at where price is trading at. So somebody is really wants to either build or exit a position at this price. And when you look at it compared to the best bid, which is only 29 contracts, this is a price level now worth watching. We want to, now that we know this is important, we want to speculate on what options participants are currently have and what's the highest probability of these options that they're taking. Are they building a position? Are they exiting the position? Either way, this is now a price level worth watching. I'll mark it down on my chart. And whenever price trades later on, I'll know that somebody who had participants that had a large amount of margin were able to put 1,100 contracts in together, whether it's one person or 20. And this was a price where a large amount of participants cared about a lot. So when price retraces to it, I'll be able to enter or exit a trade based on this. And once again, there's no specific, hey, when you see a large limit order on the ask getting executed on, it's not so simple. There's a lot of nuance to it, as to say you're always going to short or you're always going to long, or you're always going to look for price to go higher or lower. There's the nuances is what changes your thesis. And that's what you need to understand. The more experience you have looking at these things, the more you'll be able to put the pieces together and construct a trade on your own. A couple more examples here. We have short-term high liquidity that's skewing the auction. You see, look here, they're entering some large limit orders and then they're pulling them as price gets higher, closer to them. Once again, price goes down and they put some large limit orders in, price comes back up and they disappear. So it looks like the intent of these large limit orders is to skew the auction and scare them into going price low, getting price lower. So they're saying, hey, look at these large limit orders. There's a large amount of sellers here. They're probably there for a reason. They're trying to skew the price action. And you can see that they're not getting executed on. As soon as price gets close to them, they pull those orders. On the bottom in the dark white, you see long-term high liquidity and it's remaining in the book. So that tells us the intent of them is to stay, is most likely going to be to stay and get executed at some point in time. And just a reminder, guys, with option market theory, any price, whether you're trading futures, Apple, penny stocks, Bitcoin, DeFi, Forex, whatever, price is always going to look for, it gravitates towards liquidity. It's not always going to go to every liquidity pool, but at some point in time, price looks for liquidity and that's when it finds balance. And that's when you'll see these chopping and ranging markets because it's in a balanced area where price is currently being accepted at. And there's more or less an equal amount of buyers and sellers that are willing to execute at those prices. So you'll see chop or range or consolidation, compression. All these terms kind of mean the same thing. Once again, we have long-term high liquidity pockets. They remain in the order book for an extended amount of time. They don't pool, they don't move their prices too much. They're just staying there. And then on the bottom, in those yellow ovals, we have short-term high liquidity, which is looks like it's attempting to skew the option in one direction. And by now, you'll start to see that, okay, I know that this white bar here means that at this point in time, there's a large amount of limit orders that for this time period, and as time goes on, they pulled them. It looks like there's more getting back in here later. And this is what you're seeing on your heat map, guys. Sweeping the order book. So sweeping the order book is a term used when you trade through one or more price levels. This is essentially if you have price trading somewhere and there's 10 limit orders on the ask and you submit a market buy order of 50 contracts, well, there's not enough limit orders currently at that ask price to execute all those contracts. So price is going to sweep to the next price level and continue to sweep these price levels until all of those market orders get filled. So that's when you see price move quickly, when there's either a large amount of market orders that are overwhelming the limit orders, or when limit orders are pulling, and so those market orders just continue moving in a direction until they hit limit orders. And that's where your next last price is being trading at. It's typically how price trades into a new range. This is your breakouts or your breakdowns out of levels. And you usually witness a combination of order book imbalance and sizable aggressive market orders, which is what I just said in terms of either too many market orders and they need to find the next limit order of liquidity, or liquidity is being pulled and it's creating an imbalance in the order book. And now the next market order has to find that next limit order. Why does price tend to stop moving when this happens? So you'll usually see a breakout and you're wondering, okay, it was a strong breakout, high volume. A lot of participants entered at this level. Why did it stop at this price range? It's either going to be because of absorption or exhaustion. Absorption is when your limit orders are so large or they're continually reloading and they're absorbing all the market orders into them. So in this example right here, you have a large amount of limit orders on the ask. Buyers are hitting market buy orders and executing into it. And as time goes by, you see smaller and smaller orders. And essentially they get overwhelmed. So they get absorbed by the limit orders. And what happens is exhaustion. There's now no more aggressive market buy orders to execute here. So boom, price will come back down because they're exhausted. There's not enough aggressors to continue the trend. Same thing here, we have some exhaustion. So price was moving down, as we see here, and it hit this large liquidity pool of limit buy orders. As we can see here in this yellow oval, not too many sell orders come in, price comes back up, no sell orders, price comes back up, one market sell order, a couple more market sell orders, but not many. So since there's not too many market sell orders, what ends up happening is price reverts back up because there's not enough aggressive sellers here to maintain this price or to continue price moving down through these liquidity zones. Another example of exhaustion here, you have price moving down. And then all of a sudden, all these market sells go away. There's not enough to keep price at these levels over time. So what ends up happening is market buy orders start to execute and they start moving price back up. So now you have a reversal here because the market sellers were exhausted and they couldn't remain aggressive and continue to hammer and sell price and hit the bid. The behavior of price. Volatility is the depth of liquidity, thin versus thick markets is something you hear a lot. As traders, we always want to look for volatility. Almost every trading plan or playbook has volatility input, so they can trade. Their trades are always based on some sort of volatility, okay? Flurries of activity. This is when you see, I have a pace of tape meter on my setup. And this is when you see, when I see areas that are support and resistance or SMAs, whatever indicators you're using to tell you like you want to execute a trade around this price level, I want to see the pace of tape or the amount of volume orders or the amount of participants increase around these levels. And that tells me that this price level is important to multiple time frame participants. So that means that it will either break out and initiate a new price range, or it will be responded at and it will break down back into its price level of balance. That's your auction. You want to use volume when you're doing it. We all talk about volume a lot. And then time cycles matter because if you're trading what's called Globex, which is the nighttime or extended trading hours for futures, there's different market participants and you'll see whether they're aggressive or passive or what their intents are. So that's why these time frames matter, because you're going to have investors who only trade at certain price levels that are very, very wide ranging. They only trade at, say, Apple. They won't exit any trades until price gets to like $450 or something. So when you see these volumes start to increase, that tells you that there's different time frame participants starting to join in now. So that's the speed of market movement or the pace of tape. You want to study price behavior. Is price changing slowly, fast? Is it retesting prices? Is liquidity shifting? And that's kind of what you want to see when you're looking at these, at your price ladder or at your heat map, your order book, whatever you want to call it. That's what you want to look at. How is liquidity shifting? How is price moving? Is it moving slow or fast? And what areas are being retested? Each market has unique characteristics, and that's why we say you want to have to know your ticker. You don't want to just be going all in on tickers that you don't watch every day. When you see traders with conviction, they're using large size. It's usually because they know the unique characteristics of their ticker, because they know it. They know how it moves. They've watched it for a long time. They get an idea of what participants are trying to do in these markets. Market mechanics are the same for all markets. So once again, the nuance will be different in terms of what the intent of those traders are, but the mechanics of what is going on, your limit orders, your market orders, how price is moving, the mechanics are the same in every market, whether it's Forex, crypto, futures, or equities. You want to start watching these and then see if you can start to predict moves in real time. So that way, that's your, instead of backtesting things or running on things before you have any information, if you're watching the heat map, if you're watching the DOM, and you're saying, okay, I see what's going on here. I think price is going to get to this, and you want to start predicting these moves. So that way you can execute trades off. Just wrapping things up here, guys. Bookmap is just one more tool in your toolkit. It's not an indicator. It's not going to tell you to buy or sell in any way. What it is, it's a tool. The more you use it, the sharper that tool gets, the more useful it is. Similar to like an impact drill. If you use it all the time, you know what settings to put it at certain times of the day, or what tool, or depending on what materials you're working with. And the more you use it, the more experience you get with it, the more useful it will be in your repertoire. Most of these softwares and products and indicators, whatever you want to buy, they're a tool. They're not a holy grail. They're not going to immediately change your trading. They're a different tool that give you different insight into the market. And they're not a full system. So the more experience you have with it, the more useful it will become. Watching the order book is highly discretionary, guys. It's not a, when this happens, do this. It's not a system like that. It's discretionary because there's so many nuances in it. It's more of an art than a science, I would say. There's no one answer signal to give you a trade. There's a lot of things that you put together and start putting these pieces of the puzzle together to make a trade. All right, guys, with that said, are there any questions from anybody? I'll look at the YouTube chat to see if there's any questions. If anybody has anything, bring it up. TJ, if you want to chime in with anything, feel free to let me know.
Yeah, let's review some questions. And Aaron, just wanted to say this was a beautiful lesson. Well prepared. Thank you.
No problem. Thank you. So one thing I see in the chat, I'll start up. Somebody asking, is this a Thinkorswim product? Thinkorswim created a deal with Bookmap where they integrated into Thinkorswim, but Bookmap is a standalone software that you can download just like Thinkorswim. It's been on, since the first time I remember hearing about them was 2015. So they've been around for a good amount of time now. And the good thing I like about Bookmap is you'll see that they're constantly creating updates and constantly creating new dynamics into their software. So that tells me they're actively investing into their software to try and make it better, because they understand, just like market regimes change, their software has to change with it and be able to allow their traders to see these different environments from a different perspective that will help them. So that's one thing I think that one reason I think Bookmap is useful and credible is that if you subscribe to them, they have active customer service. They have YouTube streams all the time. If you go to YouTube and just search Bookmap, they have their own page and they have hundreds of lessons from different traders. They have Italian traders, they have French traders. They have guys from all walks of the earth giving lessons on how they use Bookmap. They also have auction market theory lessons, which I highly suggest if you are on the United Traders Discord server. I have a channel called OrderFlow, and I post a lot of these YouTube videos that I find useful in there. A lot of the auction market theory and things I trade off of are in that OrderFlow channel. So feel free to take a look at it. It's in the training subsection on the United Traders Discord. Somebody said, is Iceberg the best feature? Iceberg is very useful. I honestly really like Bookmap's Iceberg. There's a certain caveat to this because if you guys remember what I said early on in the presentation, I pay for my data feeds. So it's tick data that's not aggregated. And it's from, I have Rhythmic and CQG data feeds. And Rhythmic offers what's called MBO price data. It's called market by order. And what that does is it separates all the limit orders by account. It's an effort from CME to create a more transparent exchange. So what it does is instead of showing 20 limit orders on the bid at a price level, it shows how many contracts each account has at those levels. It's pretty useful. And that kind of substitutes for like an iceberg indicator, like somebody's asking in the chat. But icebergs is a concept that you want to read up on, and you won't gain as much from it if you don't watch the price ladder or the heat map, whatever you're looking at. If you don't watch it constantly, it's going to be very difficult to understand how it affects trading. You want to see it live in real time, and that's what's going to give you the greatest context. Let me see. Let me get back. Any more questions? If anybody sees one, please feel free to let me know.
Oh, that's a good question. How do you weigh Bookmap information when you are deciding to make a trade?
So the way I weigh it is because when I'm entering a trade, regardless of whether it's a swing trade or a long-term, 1 year or longer horizon, my goal on that day is to enter at the best price level I can for that specific day. So I weigh it heavily. Anytime I'm entering a trade, whether it's a scalp, day trade, swing trade, I want the best price level. And these tools allow me to get the best price level at that current time. So if I'm using these tools and they're telling me, it looks like my discretionary, information is telling me that it looks like price is going to go down. If I'm looking to build a long position in Apple, I'm going to wait and wait for exhaustion or absorption on the downside so I can enter at a price point that will be the best for my position that I'm trying to build, whether it's a scalp or a swing trade. So I weigh it heavily. Whenever I'm entering trades, I try and base it off my order flow tools because, like I said, it doesn't matter. You're always trying to get the best price of that day, whether it's for that specific, a 30-second scalp, which I do a lot of, or if I'm switching over to my swing trading account where I hold for many months, I still want the best price on that day. So I'd say it's the majority of my entering of trades. Somebody asked if heat map shows dark pool liquidity. There's no dark pool for futures, guys. Dark pools are a service that's offered. It's an exchange that's offered, and it's not something, since there's only one central exchange for futures like ES, it's CME. All the contracts are traded through the CME, so they're not negotiating different price points at a different exchange. Dark pools and equities are done, and they do not show that. No, because that's an agreed upon price where it's two large entities, whether it be a market buyer or seller. They're not basing their price on what's going on right now. They're saying, hey, take this many amount of contracts from me and I'll give it to you at this price. So it's not something that will ever show up on any of these tools. Someone asked if you can highlight CVP and SVP. That's this SVP is your session volume profile. You can change the colors of it. You can make them whatever color you want in the settings. And then you can change them from session or to the current volume profile, which is just what's currently on your screen. I'm not sure what else you mean by highlight. Is there anywhere to get Bookmaps outside of TOS? Yes, Bookmap is a standalone entity. You can download Bookmap directly from Bookmap's website. If you just type in Bookmap into Google, you'll see it, and they have all their information. It's its own software that you download and you run it through there, but you have to have a data feed. If you're using it through Thinkorswim, Thinkorswim gives you a free data feed from DXFeed, and it uses that to upload the information into Bookmap. Whereas other softwares that aren't what is it called, the OrderFlow, the sell OrderFlow brokerages, they have you pay for your data feeds. You plug that into the Bookmap software, and then it populates, and it's its own standalone app.
And Aaron, I had a question. So with TOS, they don't have tick by tick like volume data, right? It's all kind of compiled together, right?
Correct. Yeah.
Blocks.
And because that's you're getting it for free, so in an effort to decrease their bandwidth, if they gave you tick data, their internet service provider prices would be through the roof. So they aggregate their tick data, and that's how they decrease their bandwidth, decrease their cost, and then they sell your order flow, which pretty much offsets their data feed prices. That's why they don't charge you prices. There's a lot of more detail on them, which you have to find through blogs. I've seen the blogs say that anything past, I want to say 10 minutes is not is aggregated tick data for Thinkorswim. I'm not sure if that's 100% accurate, but the whole point is that it's not tick data on Thinkorswim.
And what about for the paid version?
The paid version,
subscribe on TOS.
So the paid version gives you access to all the equities. And I haven't looked at the back end of it. I could ask this guy I know with Bookmap named Doug. I have his Discord, so I'll ask him about that specifically. But I do know it still executes through DXFeed. I'm not, and I do know that I have compared my Bookmap with a Rhythmic paid data subscription with the Thinkorswim Bookmap, and the limit orders that are shown on the current order book are the same. However, the market orders that execute, I can't confirm that yet, if they're exactly order by order precise, or if they're aggregated to some extent on their own.
All right, that makes sense. You know, I used Bookmap before when I was trading like low floats, because it's so much easier to see liquidity. And I found it to be really useful because, just like you mentioned too, right? When you're like trading so many different equities, you go to one chart, you don't get to get a full read. You see the candlesticks, you don't see how it's forming, right? So being able to kind of map out the previous orders is so helpful, because it'll tell you if this is prime for like a correction. What if it was just one sell order that tanked it, right? There was one example that you showed where it's the one where you had like 5-second Bookmap and then the 5-minute candle.
Oh, yes. Let me go to that.
Yeah, let's go back to that one. So you see in the middle, the red candlestick with the tail.
Yes.
It does look like, oh, this is a bullish reversal because you have a wick underneath it. But if you take a look, you can actually see it was like one huge order tanked it initially around 10:38, and then another one tanked it closer to 10:39. But it was like a few orders that was tanking it, right? And then there's more buyers that absorbed all that move, and you can see that absorption with the pie graph being like a little bit bigger, those bubbles, and yeah, and then moved right back up. So That is important for me. That shows me that, okay, yes, there was some selling, but it was like, it could be one order, it could be just a series of orders and stop losses getting triggered, and then we moved right back up.
Exactly, and that's a lot of the things that you'll notice when you pay more. When you start watching these on a daily basis, you'll start seeing stop runs happen in real time. Because what happens is, like TJ said, on the left of this middle red candle, you see a point where price just completely gets swept through, and there's no orders executed on this red price line. That tells me that was a essentially a lot of orders got stopped out and price dropped very quickly through. And then it looks like some absorption happened, and then price started to reverse on that end. So it gives you a more of a reason as to why, other than just, oh, okay, it's a bottom wick that tells me it's bullish. It kind of tells you that, once again, the microstructure, like TJ said, it was one large order that seemed to start to initiate that drop. And then a lot of small buy orders on the reversal started coming in and started to ride price up.
And I think that's everything. Don't want to take up more of your time. Thank you so much for generously offering to do this lesson, guys. Please give him a shout out on Discord, guys, because Aaron's been working on this for a couple weeks now, and want to give a shout out to our training team as well. They have really worked hard on building this presentation up for you guys. So thank you to the team, and see you guys later.
Thank you, guys. Appreciate it.